Hi, folks. Welcome to Passpod, your passport to all things investing in the US financial markets. My name is Kalu Aja, and I'm going to be your host for the next 10 minutes. This week, we're going to talk about the US markets, right? What happened last week and what's going to happen in the coming week. And in between, we're going to talk about inflation because it's pretty important that you understand what inflation is and how it affects you as an investor. But first, we're going to take a 1 minute break to talk to our sponsors, Passfolio, which is a financial app you can use to invest in the US market. It's used by over 180,000 investors in about 170 countries. So I'll see you guys in a minute. All right, guys, welcome back to Passpod, your investment and financial show that talks about all things investing in the US markets. So let's talk about what happened last week. Let's pull up our dashboard, right? But first, let me explain to you how investing goes in a financial system or in a market as large as the US, which is the most liquid market in the world. Now, it's a system, right? So if you're an investor, your money is either in equities or is in fixed income. So it's either invested in where you get a fixed return or in a variable return like stocks. It can also be in gold, which is like a commodity, or it could also be in real estate. Money moves around, it's seeking for a higher return in the market. So when the markets and the returns in the fixed income goes up, money goes to the fixed income. If stocks have a better dividend yield, money goes to the stocks. So it's moving around. It doesn't sit in one place, right? That's what you have to remember. So last week, what happened in the markets? Well, the stock market, as measured by the S&P 500, which is about an index that measures the performance of the S&P 500 index, that was down. And that was down primarily because of the tension that we had with Russia and Ukraine, uncertainty in the market. So that was down, right? Also the NASDAQ, that's the tech heavy index as well. That was also down. So variable income was down. What about fixed income? If you look at the 10-year return, that's the US bonds 10-year return, 10-year US bonds return, that was up. So money was flowing from the variable income, the risky part of the market, to more or less the safe part of the market. So the returns might not be as high on the safe side. It won't beat inflation, but it's safe, right? So because of the tensions in the world, investors are going from risky to less risky assets. That's what we saw going on the market. What about gold and oil, which are two key commodities? Oil was going up because, of course, Russia is an oil producer. If there are going to be sanctions, then Russian oil is going to be sanctioned. So the price of oil has gone up to reflect this seeming fall in supply in the future. And of course, gold is an asset that always does well when there's uncertainty. So we saw gold and we saw oil also go up. Real estate came down as well, which was surprising, right? It's been up all year, but it's come down. So overall in the markets last week, stocks came down, fixed income went up, gold and crude oil went up in price. Now, if we were to then look at if I invested $1,000 in this market, let's say I bought an ETF from Passfolio, right? And I invested in equities, fixed income, commodities, and of course, real estate. How much would I have this time this year? If I invested $1,000, right, in the VTI ETF, the VTI ETF tracks the S&P 500, correct? So if I had put in $1,000 in that market, I would be up about 14%, give or take, this year. If I put the same $1,000 in the bond index, I'll be up about, say, $20 or so for this time this year, right? If I put in real estate, I'll be up about 5%. If I bought crude oil futures or commodities using the GCC ETF, I'd have been up about 20%. So it's the same returns that we then see in the index, but now expressed in an ETF if we're actually doing invest. So we see the money moving around. If things change out, the money goes away from fixed income back to stock. So you see that constant flow of money searching for yield across markets. All right, guys, take a break now. We'll do Passfolio ad again, and then we'll come back and then we'll talk about inflation, so you basically understand how inflation affects these other asset classes in the markets. I'll see you guys in a minute. Alright guys, welcome back to the show, Passpod, which is our show on all things investing in the US financial markets, the most liquid market in the world. My name is Kalu Aja and I'm still your host, right? So let's talk about inflation. Inflation is very, very hard to really define, but generally it's accepted as an overall rise in price of goods and services in the economy. So inflation makes prices go up. Now, to fight inflation, the Federal Reserve in the US will raise rates, because raising rates makes money more expensive. So if you're a company and you're borrowing and there's inflation, then the Federal Reserve is going to raise the cost of money to reduce the amount of money in circulation. This increase in interest rate then acts as a cost to you. So your cost of doing business goes up. If your cost of doing business goes up, your earnings start to have a drag, right? So overall, in the long term, if you're paying a higher cost of getting cash to your business, that reduces your earnings. If your earnings are reduced, then your dividend that you might pay to your investors also gets reduced. This is why many investors, many analysts say that a higher interest rate is bad for stocks because it drags down earnings. Overall, that's typically what happens, right? So when interest rates go up, what else happens? Fixed income returns now start to look attractive. So if I had that same $1,000 and before I was getting 0.10 in my bank, but I could take a higher amount of risk and buy shares like an ETF to BTI because rates were just 1.0 per 0.0. Now, if interest rates go up, I can get a higher rate of return by leaving the money in my bank or by buying a bond. So that then means money would flow from the stock markets to the fixed income market. So you see interest rates, you see yields in fixed income going up, it attracts funds flow out, and then stocks start to feel that depreciation in the volume, right, of trade that's going on in the stock market. That's typically again what happens. So as rates start to go up, as the Federal Reserve starts to do what we call a tapering, which is they start to reduce the amount of bonds that they're going to buy, you're going to see funds start to flow again from the variable stock market, which is more risky, to the very, very safe US Treasury market, which might not pay as much as stocks, but it's less risky. That's what's going to happen. That's why inflation is pretty important for us. If we know what's going to happen with interest rate hikes by the Fed, we can understand what the market and how the market will react. Then we can take a position well ahead of time if we do know. That's basically what we're going to do, right? All right, guys, last break, and then we'll come back and then we'll close out with what we're expecting for the week, this week in return now. So I'll see you guys on the other side. Welcome back to the Passpod show, our show on all things investing in the US markets. My name is Kalu Aja, I'm your host. Let's now close out this week's episode by asking ourselves, what should we look out for this coming week? I have 2 economic indices and I have 2 companies I want to watch their results. I want to watch initial jobless claims in the US. Why? Because if I see unemployment going up, I know it's going to be bad for the US economy. I want to see less people filing for unemployment benefits. Number 2, I want to watch consumer spending that's going to come out in the US. I want more Americans spending. That tells me the economy is doing well because the American economy is built on consumer expenditure, right? So I want to see more Americans consuming. That tells me companies are going to do well. So I'm watching those 2 economic indices. On the flip side, I want to see Tyson Foods results come out. Why? Tyson Foods does a lot of beef. Americans eat a lot of beef, but inflation has taken the price of beef up. I want to see how Tyson is managing that price increase. Is it passing it on to consumers, or is it eating up those inflationary costs on its books? I also want to see Marathon Energy. Same thing. Energy is a big part of inflation and cost in the US. I want to know how Marathon is either passing that cost back to the consumer or is eating it up. themselves. So those two companies and those two indices will give us a better idea of the US economy, and they should allow us to then dictate how we should allocate our resources, either to fixed income or to equities or to real estate or to commodities. That's essentially what we're trying to find out. All right, guys, that's all for this week. That's our email below. Write us an email, tell us what you think, ask us a question, and we will always get back to you, right? So guys, have a good time, stay safe out there, and remember, start early, invest, watch inflation, and be a better investor. I'll see you guys next week. My name is Kalu Aja. Take care and bye.